Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letters CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Do you think we're living in kind of volatile or uncertain times? And I'm not just talking about politics, but also financially. I mean, the S&P 500 was down 21% from the high in February, and the Dow was down 18%. Of course, they both bounced back a little bit, but they're still down, while interest rates are up actually a little bit over that time period. Hey, welcome to Reverse Mortgage Radio, the show that's all about helping you live better, longer, and with more peace of mind in your own home. My name is Bruce Simmons, and I've been helping older homeowners unlock the power of their home equity with reverse mortgages for over 22 years. Today's episode is about three things that I think, honestly, most people want. In fact, in uncertain times, I think people crave these, and especially in retirement. What I'm talking about are three words: certainty, simplicity, and safety. That's what this show is going to be about today. Believe it or not, a reverse mortgage, when it's the right fit, can provide all three of those things for you. So let's dive in. First off, I want to start off with certainty. In retirement, things can feel up in the air, especially if you're new to it. My in-laws said the first 2 years that they were retired, they did not budget. They didn't have a budget at all, and it hurt them over in their later years in retirement. But, you know, your income, it's not what it used to be, obviously. And it can be difficult to create a budget. Markets go up and down. You still got money invested usually. And when unexpected expenses pop up, they pop up fast. And suddenly they got to be dealt with. A reverse mortgage can be a financial anchor for you. Okay? That's the key thing I want to focus here on, the safety thing, that the financial anchor that the reverse mortgage provides for you. It's there. It provides certainty. Basically, the number one certainty that it provides for people is no more monthly mortgage payments. The home stays in your name. It's still your property, so you have to continue to pay your own property taxes, your homeowner's insurance. You have to live there as your primary residence, and you have to maintain the home and keep your name on title. But as long as you do those 5 things, which you would do if you owned your home free and clear anyway, right? You do those. There's nothing unique or different about it. You would do those if you owned your home free and clear. But there's no principal and interest mortgage payment on it. You get to stop making that payment. And this can free up hundreds or even thousands of dollars a month. The second level of certainty that a reverse mortgage could provide to you is a possibility of monthly payments. That's one of the options with reverse mortgages. You can set this up so many different ways. And we'll touch on a number of different ways that you can do it. But you can actually receive a monthly payment every month from your reverse mortgage. If you want to get that, it's coming to you, okay? With a HECM, a home equity conversion mortgage. That's the FHA insured reverse mortgage program. And you could choose to receive monthly payments from the value of your home. It's just like getting a paycheck in retirement, only you don't have to pay taxes on it, right? The reverse mortgage, the funds are considered loan proceeds. It's not taxable money. So there's no taxes on it. Now, conversely, you're not going to be able to deduct any interest on the loan because you're not paying it back. You don't have to. If you do decide to make payments, and we're going to touch on one of these scenarios later in the show about that, but if you do decide to make payments, you can then possibly deduct the interest that you've paid. But you're not paying it most of the time. most of my clients do not make mortgage payments. And if you're not paying it, you're not going to have to deduct it. So I call it a tax neutral loan. You're not taxed on the money you get, but you're not going to be able to deduct any of the interest you're charged. Okay, but just imagine how your life could improve if you're receiving even just an extra $500, $800, $1,000 a month every month. And it comes like clockwork, automatically. And we're going to talk about safety issues because it's guaranteed by the Federal Housing Administration. But it could be set up over a term time period, say over the next 5.5 years, or it could be set up guaranteed as long as you live in your home. It's amazing the flexibility that provides. The third certainty that reverse mortgages can provide you is that the money will be there when you need it. Now, this is big, really. Think about it. Sometimes people ask, well, what if the lender runs out of money, or what if they go out of business? But with a HECM, a home equity conversion mortgage, the funds you're promised, they're insured by the federal government. The Federal Housing Administration guarantees that if you're approved for the loan, the money will be there for you, period. No matter what happens to the value of the home, no matter what happens with interest rates, no matter what happens with anything, as long as the government's around, you're going to get your money. That's guaranteed. And now here's a quick short story, because I had a client named Helen. She was a retired office worker. She was actually on 2 bowling leagues. I remember this. I did the loan for her in 2004. Back shortly, I'd only been doing the reverse mortgages for about a year, but I was on a bowling team too back then with a bunch of other dads from my son's Boy Scout troop. Our bowling team name was the Barking Spiders. 20 some years ago. That was an interesting time. But this lady, Helen, she owned a small condo in Westminster, and we set her up with a HECM. That's the home equity conversion mortgage. The abbreviation is HECM, and we just call it a HECM. And she was able to eliminate her mortgage payment. It wasn't much, but it was $325 a month. And we were able to provide her a monthly income, it was not income, but a monthly payment of $245 a month. It was guaranteed as long as she lived in her home. She just received it every month like clockwork. So her net result to her was about $560 extra she had from the money she got from the reverse mortgage and her saving that $325 on her principal and interest. It made a gigantic difference, because her Social Security at the time was not much. Now, granted, this was 20 plus years ago, but she was only receiving about $950 a month from Social Security. And she had these 2 bowling teams she was on. That was very important to her. She's on 2 different leagues. She bowled on Tuesdays and Thursdays. I remember specifically, and she was it made a gigantic difference to her. She was actually the first customer that ever hugged me at the closing to thank me. It made a gigantic difference to her in her life. She called it actually getting a raise from her house. That's certainty. In her mind, it was certainty, and it helped her live a better life, really, in her own home. Okay, so that's the first S-sounding word, certainty. Begins with a C, but it sounds like an S. One of those tricky English words. Now, the second part of this is simplicity. Yeah, believe it or not, reverse mortgages can be simple, and they should be simple. The problem is that some people make them a lot more confusing and complicated than they really need to be. Now, why do most people think that the HECMs are complicated? Well, they heard horror stories from years ago, and usually not even factual ones. They say, oh yeah, my brother-in-law's sister's parents did a loan and they got foreclosed on because they had a reverse mortgage. Well, that's not going to happen. If they got foreclosed on at all, it would have been because they didn't pay their taxes or their property insurance, or it's possible that maybe they left the home. They moved to assisted living And then because they didn't pay off the reverse mortgage or sell the house, the bank had to foreclose on it. See, the way a reverse mortgage works, let me do a quick background here. Oh, by the way, too, if you just tuned in, you are listening to Reverse Mortgage Radio. My name is Bruce Simmons. I'm the reverse mortgage manager for American Liberty Mortgage. We're located here in Denver. And one of the ways that I simplify reverse mortgages is I like to meet people in person. Most of the time, when you call me, I'll set a time and come out to meet with you, or we could do a Zoom call if you're not comfortable with meeting with me, or you can come into my office too and see where we're at. We have a physical location, and it's a nice area in Denver, the Highlands area, and we're legitimate. And I will sit down with you and take as much time as it takes to explain it to you, your adult children, your financial advisor, your realtor friend, whoever you think is important and you value their opinion. And then you have to talk to a reverse mortgage housing counselor before you're allowed to sign any papers. One person said, "Oh, I don't like that. I think that makes it sound like there must be something shady going on because you have to talk to a counselor." No, it's the exact opposite. Basically, when this program was set up in 1988 is when the program was set up. HUD, the federal government that set this up with HUD, HUD is the Housing and Urban Development, and FHA is underneath HUD's oversight, if you will. But basically, when they set this up, they did not want the little old lady who doesn't understand finances to get swindled by some slick talking salesman and get something that's not in her best interest. Okay, I know that sounds sexist and all this, but I think that's what they were thinking at the time. Now, I do this loan for retired financial advisors and real estate professionals and business executives. It's not just simply for the poor person who is desperate. That's one of the biggest misconceptions about reverse mortgages is that it's only for desperate people. That is flat out not the case. Okay, but basically, the way the reverse mortgage works is you don't have to make a payment like I talked about. You still have to pay your taxes and insurance and things, but you're still charged interest every month. That interest gets added to your loan balance. Every month you get a statement in the mail, and you're going to see that balance getting bigger and bigger and bigger. And I sit down with you and go over all of those numbers. I make sure that you understand how that works because sometimes I do have to use those jawbreaker words like my grandpa used to say, like negative amortization, those big words like that. But really, it's not that complicated. It's very simple, actually. Part of the reason people feel confused is they don't understand how the loan is repaid. It's amazing the number of people who still think that the bank either owns your home when you get the reverse mortgage, which isn't true, or that the bank's going to take your home when you die and your heirs don't get anything, or that the bank's going to sell the house, and if there's any money left over, then the bank will give your heirs that money. That is not how the loan works. Basically, when the loan only comes due when the last homeowner permanently leaves the home. Whether you pass away or you move to assisted living or you move in with your kids, whatever the case may be, you or your spouse, both of you vacate the home and nobody's living in the home anymore. Or no borrower, I should say, is living in the home anymore. And when that happens, then the loan balance comes due. Your heirs inherit the home. They have the options to either sell the house and pay off the reverse mortgage, or they could refinance it and keep all the equity in the home too. If there's no equity left in the home, let's say that the value of the home has gone down, like in 2008, and the balance has gone up because you're charged interest every month, and that interest gets added to the loan balance. Now you owe more on the house than it's worth. Well, part of that safety thing that we're going back to is that you can never pass a debt beyond the value of your home. And like I said, the bank can never take your home, no matter what the value of your home is compared to the amount owed. But if you leave the home permanently, and let's say the home is only worth $400,000, but you owe $500,000 on the reverse mortgage, you're not going to pass that debt to your estate. Your heirs could simply sign the house over to the lender and walk away. In fact, I've got a story about that we're going to touch on in a minute. But or if they wanted to keep the house, they could just get a new loan for 95% of the $400,000 current value. Even though $500's owed on it, they go get a loan for 95% of the $400,000 value, and they can keep the house. So they don't have to pay everything that's owed on it in that situation. Now, it's very unlikely that situation is going to happen because we don't loan 70 or 80 or 90% of the value now. But anyways, that's one of the reasons, too, that people get confused. They think it's confusing. Another, probably the most common one, is they've never actually sat down with somebody and had somebody who understands it really explain it to them in plain English, okay? It's amazing the number of people who think that they understand this program, and they don't. So you're talking to your neighbor, and your neighbor could be a retired financial advisor who still has these old horror stories in his head about somebody that got foreclosed on when they had a reverse mortgage, and thinks, oh yeah, this is a bad thing. And you trust that person's opinion, but that person who's telling you about it doesn't really understand it themselves. So how can they explain it to you when they don't understand it, but they think they understand it? That's the problem. Way too many people understand reverse mortgages that don't really understand reverse mortgages. It just, that's a huge part of the problem. So keep that in mind. And it's a very flexible program because you can take money out in any one of four ways. You could take it as a lump sum. If you have money, let's say you own your home free and clear and you want to pull out a big lump sum of money. You could do that with a reverse mortgage. Now there's restrictions now that are in place to so that you're not going to blow it all, say, but those come from experience because people did that. You can also receive monthly payments like we talked about in the last part under the safety issue. You can also set up a growing line of credit. Yeah, the line of credit gets larger over time. Unlike a traditional home equity line of credit that you get at your bank, a HELOC, the reverse mortgage line of credit is way, way better because it grows over time. It's 100% guaranteed. It can never be closed out, all these things. Or what most people do is some kind of combination. They take out some money up front to pay off a mortgage. They might even set up a monthly payment and still have money left over in a line of credit. It just depends on your specific situation. You might want to pull out, if we can only loan you $200,000 and your mortgage is $195,000, well, we have to pay off the existing mortgage first. That's $195,000. So that means you only have $5,000 left over. However, you don't have to make that mortgage payment anymore. That could be saving you hundreds or maybe more than $1,000 or $1,200 or $1,500 a month, depending on your situation. Just like, for example, a quick story here. Jim and Sue live in Arvada, and I met with them when their financial advisor actually referred them to me. The financial advisor is a sharp guy. He's referred a number of his customers to me to talk about a reverse mortgage. It works for some, it doesn't for others. But the problem was Jim was retired. Sue was approaching 70, and she was still working because they had mortgage payments. They had a first mortgage and a HELOC. And their payments, the principal and interest portion and the HELOC part, totaled $1,182 a month. And Sue didn't feel like she could retire comfortably and have the peace of mind when she still had those big payments sitting out there. So we were able to pay off both loans for her, pay off both those mortgages, and they had $27,347 left over in a growing line of credit. They could make payments, but I don't think they've been doing that. Sue was telling me how, because I followed up with her a little while after the loan, and she said, oh, she's just loving life now that she's retired. She was working in her garden and volunteering. And that is peace of mind, and it's just a lot simpler than what you would think. Okay? So now let's talk about the third S, which is safety. And this is where reverse mortgages really shine. The program, like I said before, has been around since 1989. for over 35 years. This is not some newfangled financial program like the mortgages in 2005, the option arms. That's what I was thinking. The option arms, where you could make these different payments, and they came with teaser rates and all this stuff. No. This has been around a long time. It's fully integrated into the Federal Housing Administration loan system. And since 2009, there's been a number of safeguards that have been added. Now, even before 2009, from the beginning of the program, I think pretty close to it, we've had the counseling that's required. You have to talk to an independent third party that's approved by HUD before you can sign any papers on the reverse mortgage, because they want to make sure that you understand your responsibility with the loan, that you have to continue to pay your property taxes. You have to pay your homeowner's insurance, maintain the home, live there as your primary residence, and keep your name on title. They want to make sure you understand that, because not all loan officers are as clear as I am about explaining that. They also want to make sure that you understand how the program works, the negative amortization, the different options as far as a monthly payment. Some loan officers try to get you to take all this money out up front that you don't need because they get paid on the size of the loan. Don't do it, okay? I promise you, don't do it. Another thing that some loan officers try to get you to do is to give them their Social Security number when you're just shopping around. You're just trying to find out what's available. Don't ever give your Social Security number out to anybody until you're sure you want to do business with them. Okay? Once you want to do business with them, they're going to have to check your credit, because that's one of the things that came in 2009. Well, actually, in 2014 is when HUD began financial assessment. And we need your Social Security number to be able to check your credit. We have to check your credit and income to make sure that you can afford to live in your home, that you're not overextended with other debts outside of the mortgage and things, but also that you pay your bills on time. Because if you're not responsible in paying your bills on time, when it comes time to pay your property taxes or your insurance, you may not do that. And we want to make sure that you're going to continue to do that. There's also protections now for non-borrowing spouses. We've talked about this many times on the show. As far as the non-borrowing spouse, if you're 65 and you're lucky enough to be married to somebody younger than you, say 55, that person cannot be on the loan. But there's still protections for that person who's not technically a borrower, because that person's not old enough to be on the loan. But if something happens to you where you can't stay in the home, you're not the non-borrowing spouse is not a borrower. Technically, the loan comes due. But they have what's called a deferment period as long as the non-borrowing spouse is living in the home and paying the property taxes and insurance. And that protects that person, so they're not going to get kicked out of your home and or have to sell the home. There's also, and we touched on this briefly, there's limits on the amount of money you can take in one lump sum. We call it the initial disbursement limit. In the first year, back in 2005, 6, and 7, before the 2008 crisis, there were a lot of, some of the subprime people who did subprime loans got into reverse mortgages. And they were talking people into taking all the money out in one lump sum. And they weren't real clear about the fact that you had to pay your taxes and insurance and all the rules. And the counseling was a lot less stringent than it is now. Now we've got standards for counselors that they have to pass tests and things to understand what they're counseling you about. But you can't take all the money in one lump sum, because that's part of the problem that gave reverse mortgages a black eye, in all honesty, is that they weren't explained properly to people because of the people that were doing the business then, some of them. Anyways, I've been doing this since 2003, and I always made sure that people were doing it the right way. But also the annual letters that go out that they want to make sure that you're paying your taxes and insurance and living in the home and things of that nature. There's also protections for the appraisals, because part of the problem with the 2008 crisis was the appraisal issue, that there were lenders that had appraisers that would puff up the values. Now we've got collateral risk assessment, where HUD reviews every single appraisal from a reverse mortgage. They do it through an electronic valuation model, EVM, or an AVM, an appraisal valuation model, but they do it electronically. And so these things are very make the program safe. It's much, much safer than it was before. Even though HUD has always been involved, now they're a lot more involved, if you will. Okay. For example, I did a loan for a lady back. She was one of the first loans I did in 2003, the end of 2003, because I started reverse mortgages in January of 2003, and I went to work for the Evil Empire in September of 2003. Affectionately, they're the ones with the stagecoach. I like to call them the Evil Empire. But they taught me a lot about reverse mortgages. And this lady, she really felt, even though I explained it to her, she felt that she was giving her home to the bank for this monthly payment. We were paying her every month, $1,600 a month, I think. She had lost a lot of money, or her value, her stock. She was like a business executive at the time, and she was retired. She just felt really embarrassed because she lost a lot of money in the 2001 tech bubble. And her stocks all went to zero, or very, very low. She didn't have enough money to retire, to live on. So she got this reverse mortgage. Luckily, she had a nice home near Cherry Creek High School, a patio home that she owned free and clear, and we were able to give her this money every month. And in fact, she, with all these protections, even after 2008, her home went down in value. She still got the money every month in 2008. She called me like 10 years later in 2014 and told me she was able to cancel the monthly payment because her portfolio had come back. Even with the loss she took in 2008, it came back by 2014, and she had to start receiving, at that time, I think, the required minimum distribution from her portfolio or stocks, and she was able to live on that. And she stopped the payment. Now, she didn't pay off the reverse mortgage. What happens is, this is the flexibility aspect. She was able to stop the monthly payment she was getting, and the money that we set aside to pay her got moved over into a line of credit. She still has access to that money after stopping that payment. If there was $80,000 set aside to pay her that monthly payment for the rest of her life, now it's moved over to a line of credit, and she has access to the whole line of credit because she's not receiving the monthly amount. And it's just was such a pleasure for her. She was so happy when she called me. She said, "I can't believe that I was so scared of this loan. It was the best thing she ever did." Anyways, those are the three things. So to recap, certainty. Remember, predictable income or no monthly mortgage payments, federally guaranteed funds available to you. Simplicity. It's actually a very easy loan to use and to understand if you deal with the right person. You've got flexible options, and I walk you through everything, okay? And then also safety. Decades of regulation, FHA insurance, and all kinds of borrower protection. If you feel like a reverse mortgage might be a good fit for you or somebody you know, please contact me. I offer a no-pressure, completely free consultation. You can visit me online at reversemortgageradio.net, reversemortgageradio.net, or just simply pick up the phone and call me. My number is 303-467-7821. My name is Bruce Simmons, and again, give me a call at 303-467-7821, or visit me online at reversemortgageradio.net. Thanks so much for joining me today. It has been a pleasure being with you.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.